Hello, and welcome to the Duane Morris Money and Banking Law Podcast with Joe Silvia, brought to you by the global law firm of Duane Morris. I'm your host, Joe Silvia, and I'm a former Federal Reserve lawyer who represents banks, fintechs, and other clients on M&A, payments, and regulatory matters at Duane Morris. I'm also a core member of our banking, fintech, and digital assets and blockchain practices. The goal of the Duane Morris Money and Banking Law Podcast is to inform and educate our clients and friends on both the fundamental concepts and structure of the banking ecosystem, as well as critical developments in the law and regulation of money and banking. On this episode, we're talking about the fundamental construct of a Bank Secrecy Act and anti-money laundering compliance program. Given that we have some episodes forthcoming that dive a little bit more deeply into the nuances of anti-money laundering compliance programs, thought it might be a good idea to start with some of the basics, some of the fundamentals. So we'll talk a little bit about money laundering and the Bank Secrecy Act. Then we'll talk about program requirements, all kind of in the context of focusing on banks and other financial institutions that have these obligations. We'll talk a little bit about what's called OFAC and OFAC compliance, the Office of Foreign Assets Control within the Treasury Department. Talk a little bit about enforcement, and a little bit more about the compliance, the culture, the program nature, and other expectations that are placed upon banks and other financial institutions in the U.S. So what is money laundering? It's the process of making illegally gained proceeds appear legal. So the process of washing dirty money so that it appears that it comes from a legitimate legal source. Generally, when we talk about money laundering, there's a couple of different stages of money laundering. The first stage is called the placement stage. This is where illegitimate funds are initially introduced into the financial system in some way. The second stage is the layering stage. This is really the first attempt at disguising the source of the funds. So placement may be taking illegally gotten financial funds or proceeds, putting them into your bank account. Layering is then using that source of funds, your bank account, and the funds therein, to conduct an otherwise legal transaction. Then we get to the third stage of money laundering, which is called integration. This is where the laundered or dirty money has been integrated into the financial system. So layering is that first attempt to disguise the funds. Integration happens with multiple other attempts to disguise the source of funds and ultimately make the illegally gotten funds appear legal. In some contexts, this layering and integration looks like buying real estate or yachts or expensive jewelry, or taking the cash that you put into your bank account, taking that out and going to a casino and gambling that money so that it gets layered and integrated with the other funds of the casino and other individuals and players at the casino, for example. Okay, so now we know generally what money laundering is. And the next step is to figure out, okay, well, what are the statutes? What are the regulations? And we'll talk about that in a second. But before we do that, I want to talk a little bit about what's called FinCEN, or the Financial Crimes Enforcement Network. This is the financial intelligence unit of the United States. It's housed within the Treasury Department. As the financial intelligence unit of the U.S., it is FinCEN's role to safeguard the U.S. financial system from illicit use. FinCEN combats money laundering and promotes U.S. national security objectives by collecting information, analyzing that information, and then disseminating financial intelligence throughout the financial system and with the use of financial authorities. The Bank Secrecy Act, which is essentially an amalgamation of a number of different statutes that have been passed over time since 1970 to combat money laundering in the United States, has turned to the Treasury Department and essentially FinCEN to require banks and other financial institutions to prepare, maintain certain reports and records that might have some kind of quote-unquote high degree of usefulness in criminal tax or regulatory investigations or proceedings, or in the conduct of intelligence or counterintelligence activities, including analysis, to protect against international terrorism, unquote. Based on the authority, FinCEN promulgates regulations that govern anti-money laundering requirements and programs for financial institutions in the United States. As a quick aside, our focus today is on banks and kind of traditional financial institution programs, but the Bank Secrecy Act and the regulations that implement it actually include a number of other kinds of entities under the definition of a financial institution. Things like casinos and money services businesses, money transmitters. These are each of those kind of awkwardly fitting financial institutions under the FinCEN regulations, but are subject to very much the same program requirements that we're going to talk about today. So the Bank Secrecy Act came out in 1970, and it wasn't called the Bank Secrecy Act. It was actually called the Currency and Foreign Transactions Reporting Act of 1970. And it's a statute in the U.S. that requires banks, financial institutions, and others to help detect and prevent money laundering, terrorist financing, and other financial crimes. And the focus initially was on reporting and record keeping of certain transactions for the use of the Financial Intelligence Unit, FinCEN, and the Treasury Department in combating money laundering. For example, the Bank Secrecy Act, as we call it today, requires financial institutions to keep records of cash purchases of things like negotiable instruments, the filing of reports for cash transactions that exceed a daily aggregate amount of $10,000, and the reporting of suspicious activities that might signify either money laundering, terrorist financing, some kind of tax evasion, or other criminal activities. After the September 11th attacks in 2001, we enacted the USA Patriot Act, and that amended the Bank Secrecy Act and requires, among other things, government institution information sharing and voluntary information sharing among financial institutions. The Patriot Act also includes provisions related to including a program for verifying customer identities, enhanced due diligence programs at financial institutions, and then broadly anti-money laundering programs across the financial services industry to enhance the combating of illicit finance. All right, so now what are the basics of a program, right? So the Bank Secrecy Act, anti-money laundering compliance, requires financial institutions institute a written compliance program, traditionally viewed as having four pillars: internal controls, independent testing, an individual or group of individuals that are responsible for the program, so a BSA officer or a BSA function, and then finally training for the employees. It also includes a requirement for customer identification program and customer due diligence. Now, before we get to building out a program, we tend to work with clients on the first step, which is really what we call the risk assessment. And in the risk assessment, just like other areas of bank and financial institution compliance and risk management, we need to consider the products, services, customers, vendors, geographic locations, and otherwise that are important for assessing risk, especially in this case related to anti-money laundering, countering the financing of terrorism and such. This risk assessment needs to be conducted periodically and updated on a regular or periodic basis. It also needs to be in written form for a number of reasons, including for the assessment by regulatory agencies to review and consider the appropriateness of the scope, and complexity, and so forth of the risk assessment. This risk assessment is intended to be a dynamic assessment of the risks. It is not supposed to be static. It is supposed to be a dynamic assessment of the risks. So something that we talk to our clients quite a bit about is how to make these risk assessments and the analysis more dynamic, especially as the digitization of finance happens, the international regimes of finance become more robust and borderless in many cases. So in terms of the program, the first pillar is what we call internal controls. So these are the financial institution's policies, procedures, processes. They're designed to comply with the requirements of the Bank Secrecy Act and its implementing regulations, and to also control the risks of money laundering, countering the financing of terrorism, and so forth. The internal controls generally have to be designed to do a number of different things, but identify the operations that are vulnerable to abuse, provide for periodic updates of the risk profile for the institution, and provide for a compliance program that really is tailored to manage those risks. In addition, you have to have involvement from the board of directors, senior management, talking about compliance initiatives, identifying compliance deficiencies, taking the corrective action, and then really keeping informed and notified when SARs or suspicious activity reports are filed. And again, those are the reports where you suspect some kind of activity related to a criminal or illicit financial activity. Internal controls generally also need to identify a person or group of persons that are responsible for AML compliance. So a BSA officer, they need to implement risk-based customer due diligence policies and programs, identify reportable transactions so that we accurately file the SARs that I mentioned, what are called currency transaction reports, the CTRs. And those are the reports that are filed when somebody engages in a daily aggregate amount of $10,000 or more in transactions. For the independent testing component, the second pillar, it's really the audit, right? So it should be conducted by either the internal audit department, outside auditors or consultants, or some other qualified independent party. And this really depends on the size of the institution. The size of the institution and the complexity of the institution will really dictate whether you're talking about an internal third party, an internal audit department, or an outside audit group. So the frequency isn't really specified. It's not required that it be every 6 months, 12 months, 18 months, but suffice to say, the regulators expect it to be commensurate with the risk profile of the bank related to anti-money laundering compliance, but usually on an annual or semi-annual type of basis is what we see in most cases. Banks that don't use outside parties, outside auditors or consultants, may comply with the requirement by using qualified people internally that are not involved in the function that's being tested, so not involved in the AML compliance function. Again, some kind of independent party. Finally, the people that actually conduct the testing need to report directly to the board of directors or to some designated committee that are comprised primarily or completely from outside directors. The independent testing includes an evaluation of the overall adequacy and effectiveness of the program, reviews the bank's risk assessment or the financial institution's risk assessment to make sure it's reasonable given the bank's risk profile, right? The products, services, customers, entities, geographic locations, offerings, and so forth of the institution are all taken into consideration when reviewing whether or not the risk assessment is appropriate. I mentioned the BSA officer, the third pillar, right? Some designated person or group of persons that is responsible for the program. So the board of directors is really the one that is required to designate a qualified individual to serve as the BSA compliance officer. The compliance officer is responsible for coordinating and monitoring all the day-to-day basics of AML compliance, and they're also charged with managing the aspects of the compliance program and adherence of the bank to the statute and regulatory compliance obligations. Ultimately, though, the board of the directors is the one responsible for AML compliance. The board of directors is responsible for ensuring that the compliance officer has sufficient authority and resources, which is monetary resources, physical resources, personnel resources, to actually administer an effective AML compliance program. Again, based on the bank's risk profile, risk assessment, and certain other characteristics. The final pillar is training. So banks have to ensure that appropriate personnel are trained in the applicable aspects of the Bank Secrecy Act and FinCEN's implementing regulations. The training needs to include just an overview of the regulatory requirements, an overview of the internal policies, procedures, and processes of the bank, and it has to provide training for anyone at the bank whose duties require some knowledge of BSA AML compliance. It should be tailored to the extent possible to the person's specific responsibilities and role within the organization, but also should be added to any kind of new staff orientation, and just as a general overview, at least for AML requirements, so that they're aware. The BSA officer, him or herself, also should receive periodic training that is considered relevant and appropriate given to changes in either the regulatory environment or the specific activities and or risk profile of their particular institution. So within the training, we would expect to see exactly what we're talking about right now, right? So the policies and procedures of the bank itself or the financial institution itself, a review of the 3 stages of money laundering that we talked about, red flags that help identify situations of potential money laundering and other criminal or illicit affairs, customer due diligence and customer identification program requirements and specifics, the reporting and filing information and basics of the SAR reporting and CTR reporting I mentioned before, procedures for reporting issues up the chain, and finally, incorporating changes to the BSA statute structure and then any implementing regulations that are applicable. Just quickly, I wanted to touch on a couple of common issues that we see with respect to these 4 pillars specifically, and issues in terms of where people miss out on having adequate and appropriate regulatory compliance in this area. First, with respect to the internal controls, the biggest challenge, the biggest miss here is twofold. One, not having policies and procedures written down and controls that relate thereto in written form adopted by the board, just not having them, period. That is likely to lead to some level of enforcement action. The second is really just having an off-the-shelf kind of policy and procedure. Again, each of these internal controls and the development needs to be tailored to the specific financial institution and its risk assessment and risk profile. So an off-the-shelf kind of policy and procedure just isn't going to work. Second, with respect to independent audit or independent review, you need to have the reviews. You can't have them infrequently, but they don't have to be every 3 or 4 months. They should be on some kind of periodic basis and should be conducted whenever the institution has a material change to its risk profile or risk assessment. A second miss on compliance is really not remediating risks that you identify in the independent audit or independent review. With respect to the BSA officer, compliance issues tend to creep up when you don't have board approval and or the business awareness of the BSA officer is lacking. Finally, with respect to training, you need to make sure that you're not only focusing on money laundering issues. Money laundering and the AML compliance program are broader than just reviewing the 3 stages of money laundering. Another aspect of training programs that we see where compliance obligations and activities fall short is sometimes having unclear escalation procedures when someone does see some suspicious activity or suspect some kind of criminal activity as it relates to a transaction or group of transactions. A couple of quick notes on some other pretty material pieces within a BSA compliance program. One is the customer identification program. This is something that has to be written and, again, appropriate for the size, scope, complexity, and type of business that the bank or financial institution conducts, subject to approval by the board of directors. And ultimately, the goal of the customer identification program is that it must allow the bank to form a reasonable belief that it knows the true identity of the customer or entity or individual with whom they are doing business. At a minimum here, we're talking about gathering information for each customer before you open an account with respect to the customer's name, a date of birth if you're talking about an individual customer, an address, and some other identification number, whether Social Security, TIN, or otherwise. Based on the risk assessment, a bank could require additional information for certain customers or for certain product lines, again, depending on the risk profile and risk assessment of the institution. Another critical component of an AML compliance program deals with customer due diligence, and this has kind of come to be known as the 5th pillar of the compliance program. Some key elements include identifying and verifying the identity of customers, similar to what we've talked about in the CIP context. but then identifying and verifying the identity of beneficial owners of legal entity customers. So in other words, the natural individuals, natural persons who own or control these legal entities that might be customers of your particular institution. You need to understand the nature and purpose of the customer relationship, whether it's an individual customer or a legal entity. What do they intend to use the account for? What kinds of transactions should be expected? What volume and degree of business should be expected from the customer? And then a critical element of this due diligence piece is really the ongoing monitoring. That's what we're talking about here. So the customer information program deals with account opening, informing yourself to a reasonable degree of who you're doing business with. And then customer due diligence is focused on the ongoing monitoring to make sure that you maintain and update that customer information and to identify and report suspicious transactions. Again, transactions that don't align with what the expectations were when the account was opened or set up. In the case of customers that may pose a higher risk, banks are required to establish risk-based enhanced due diligence for those customers. Quickly on record keeping and reporting, I mentioned before filing SARs or SARs. These are suspicious activity reports that are filed by financial institutions. They have to file these with FinCEN anytime they see a suspicious transaction that's relevant to a possible violation of law or regulation. And there's language conditioning how that's determined and so forth, but for our purposes today, filing of SARs is a critical element to any compliance program in this space. Second, the filing of currency transaction reports, which are currency transactions over $10,000, are required for banks specifically. The SAR and CTR filing requirements are in addition to reports and general record-keeping requirements that are outlined in the regulations. Finally, I'd like to mention a little bit about OFAC compliance, or the Office of Foreign Assets Control. So OFAC is a division within the Treasury Department. They administer and enforce economic and trade sanctions in collaboration with regulatory law enforcement and kind of the intelligence, the financial intelligence communities. And this is all based on U.S. foreign policy, national security goals, and the like. So while I anticipate a future podcast episode that dives a little bit more deeply into specific nuances of OFAC compliance, I want to give kind of a broad perspective because it does tie in very closely with the AML programs at many financial institutions. So under sanctions regimes, all U.S. persons, which is a broadly defined term that includes banks, non-bank subsidiaries, other financial institutions, they all have to comply with OFAC regulations. So what OFAC says is you can't engage in transactions with what are called blocked persons. Those persons are listed on OFAC's SDN list. This is a list of specially designated nationals with whom the U.S. does not want to transact business. This also includes entities in which any such blocked person owns, directly or indirectly, a 50% or greater interest. The need to implement a risk-based OFAC compliance program, again, spreads beyond just banks, but for our purposes, that's where we'll focus. The program needs to be commensurate, again, with the risks profile of the bank or financial institution. Requires screening and reporting components, which are critical pieces to this program. And again, utilizing the 4 pillars that we see in the AML compliance program, those translate nicely over to what you would expect to see in an OFAC program, using a risk assessment to determine what your internal controls, testing, OFAC compliance officer or group of compliance officers looks like, the training needed for relevant personnel, and so forth. When conducting an OFAC risk assessment, some things that are considered as important to take into consideration are things like the product lines, the customer base, again, transactions within those specific product lines that may be high risk or higher risk, taking into consideration things like geographic scope and area, identifying high-risk areas or high-risk business lines, which may demonstrate some kind of heightened OFAC-specific risk, right? Risk of doing business with an entity or an individual or a country with whom the U.S. does not wish to do business. Some examples of higher risk areas may be things like international funds transfers, foreign customer accounts, cross-border ACH transactions, foreign correspondent bank accounts, for example, or other kinds of electronic banking that are transaction accounts. Those may be subject to heightened risk or a heightened level of scrutiny under an OFAC risk assessment. So to wrap up today, we talked a lot about the 4 pillars, the different components of both an AML compliance program and briefly about an OFAC compliance program. These are absolutely critical for financial institutions and especially banks, right? Weak programs in these compliance areas can lead to significant penalties, significant fines, enforcement actions, huge expense in terms of remediation for certain program violations. And finally, weak programs can lead to significant impairment with respect to any kind of expansionary plans, strategic plans for growth, and the like. The old adage from Ben Franklin that an ounce of prevention is worth a pound of cure could not be more accurate when we're talking about BSA, AML, and OFAC compliance in the financial institution and banking space. But like I said, stay tuned for episodes in the future where we're really going to dive into a couple of these really esoteric areas of AML compliance and OFAC compliance, because again, there is such a significant amount of liability and potential exposure for banks and other financial institutions that we really want to limit in the most appropriate ways possible. Okay, so that's a lot to chew on for today, but I'll stop there. If you have any questions from any of our episodes, please, again, reach out to me at jsilvia@dwaynemorris.com or reach out to your favorite Dwayne Morris lawyer. Please finally be sure to like and subscribe to our podcast wherever you get your podcasts. I really appreciate you all listening in. Please stay tuned for new episodes coming soon, some related to AML, some related to some other hot topics, and even more related to the fundamental concepts and fundamental strategies to ensure compliance, growth, and success. Once again, thanks for listening in, and we'll see you on the next episode.